All right, yes, perfect. So what did we talk about in the previous video? We talked about the entry types. Now, of course, now we have somewhat of an idea where to enter. Now it is, of course, important. Where do we actually place our stop loss when we actually enter? So that is what we're going to go over right now, our stop loss placement. The stop loss placement is essentially, again, quite simple, but it might not be easy to understand in the first time that we go over it. Over time, a stop loss placement is quite simple, but it can also be detrimental, because if our stop loss placement is not good, then we might miss the move. We might get taken out first before the move actually plays out. And that is all things that we need to take into account. So right here, the stop loss placement is based on your last line of defense. So the lot. The stop loss placement is also one question that you need to ask yourself when you are placing your stop loss is, where does price have no reason to return back to? So where does price have absolutely zero reason to come back to before it continues higher or continues lower? That is exactly the question that we are working with. Now, those questions, and that question again, it's the same as a question where if we are going higher, where are we likely going higher from? It's the same exact question, as in it triggers those chain reactions of thoughts. The thoughts that this question, so where does price have no reason to return back to, should trigger is using the lot, so the last line of defense, but also scouting the time frames. That is exactly what we are going to go over. So I'm going to use the same examples because then it's very nice to see the differences in those examples, and it's very nice to see as well how we're building onto those examples. Right now, again, we are going over bias, narrative, boundary, target, entry pattern, and a little bit of risk management, but this is only the start of risk management. So right here, we had this monthly fair value gap sitting right there. I bet you're now getting sick of it, that I'm going over it for the 5th time, but it's great because now we are constantly drilling it into your mind. That is very important. So here, we are overtaking this monthly fair value gap, which means, of course, we are disrespecting that, which means the bias right here could be bullish overall, bias direction. Then we have this potential premium rate that we can target for that draw on liquidity. How are we getting towards that premium rate? How are we getting there? On the weekly, we have nothing just yet. All right, do we have something on the daily? On the daily, we had this daily fair value gap sitting right there. Perfect. Very nice, and we can continue higher off of that, creating that context again, right? That discount rate towards this premium rate. We also mentioned, all right, we have now sort of refined the area of where price can come back to. Meaning that this low is definitely, it's out of the conversation. As in, we should not come back towards that low. We should not sweep that low if we do want to continue higher. We have refined that even more so with now the fair value gap, of course. So the fair value gap right there is where we can expect some kind of entry pattern. So if we dive into the 15-minute time frame again, then on the 15-minute time frame, what we are looking at is a potential ST plus a RE. So we are looking to target this high right there, that intermediate term high, of course. And then right here, we have this sharp turn, the first bit, the first piece of a sharp turn, which is of course displacement into the PD array. Then we have the displacement out of the PD array right there. That creates our sharp turn. Now we wait for a retracement into a discount array to then create that new order leg higher. So we have the retracement. A retracement 9 out of 10 times, when I say a retracement, unless it's under very specific conditions that you don't really need to know right now, you just need to know what a retracement is right there. A retracement into a discount array is very simply said just a swing low created. It's a swing low created either close to a PD array, etc. But main importance is if a swing low is created right there, usually it's already trading into any sort of discount array. So if we create a new swing low and that new swing low right there creates a new fair value gap higher, that is exactly what we want to see. So a swing low being created and new fair value gap higher, perfect. That is what we would want to see. That is the retracement into the discount array to then continue higher, create that new order flow leg. This right there is an entry, because that right there is what? That's the re. That is the order flow leg higher. So here, order flow is confirmed. We enter off the float. Let's say we enter off the float right now. Whether you end the entry type here doesn't really matter. It's the same stop loss placement most of the time. So let's take a few things into account right now, because now again we have the question, well, where does price have no reason to come back to? How do we know where price has no reason to come back to? Well, that starts all the way on the daily time frame first, because this is the video we went over where we have the no return theory. The first place where price has no reason to come back to is that swing low. All right, perfect. That swing low, no reason to come back to. Well, if we enter here and that is our stop loss, that is a little bit too crazy. As in, that's not what we want to do. That we don't want to all of a sudden turn in position traders. All right, so how can we refine that stop loss right now? Well, we can refine that stop loss the same as we refined the entry with the no return theory with order flow, by looking at this fair value gap, the discount rate, and seeing if we get confirmation. Why do we do that? That is because right now, everything on the higher time frame is already in context. Now we need to make sure that everything on the lower time frame is already in context. So if we go into the 15-minute time frame and we have an ST plus RE, that means that everything below the 15-minute is already in context. Because that doesn't matter what the 5-minute and the 1-minute is doing, because the 15-minute is the time frame above the 5-minute and the 1-minute, meaning that the 15-minute is the leading time frame right there. As in, if the 15-minute right there is in context, then the 5-minute and the 1-minute is also in context. That is the same for the daily with the 4-hour and the 1-hour. So right there, everything is currently in context, meaning that every order flow leg higher here on the 15-minute currently, until we create a 1-hour fair value gap higher, is in context. Meaning that this low, that swing low is protected, and this swing low is protected. After that, this swing low is protected right there. Why those swing lows? These swing lows are responsible for creating the fair value gaps higher. So they are the actual order flow legs swing lows, as you can see them. Now, I also mentioned that if we want to take a sharp turn, this is the intermediate term low. The lowest point that came into the PD rate. That is the intermediate term low, aka that is your sharp turn low. So if that is your sharp turn low, why do we not use that one? Yes, we can use that one, but it is about refining right here. We can refine it a little bit more. Why can we do that? Because at this moment in time, we have these two swing lows. If we magically want to sweep this low right here, then why would price want to sweep this low and keep this lower low right there intact? Is there any logical reason for it to do that? Well, then the question would become quite easy. Is there a fair value gap on the time frame above the 15-minute in this area right there? If yes, then price is a reason to come back. If not, then you can cover this low right there as your stop loss right there. And you would not expect it to come back below that low. Because on the lower time frame, 100% there's likely going to be a 1-minute fair value gap. That's not what we are looking at. We are looking at, is there a fair value gap on the time frame above it? Because an order flow lag, again, an order flow lag is high probability, right? That is what we understand. But we also understand that an order flow lag is low probability if there is a fair value gap below that order flow lag on the time frame above it. So if we have a 1-hour fair value gap right there below that 15-minute order flow lag, then the 15-minute order flow lag is low probability. Why is that? Because it's not in context of the 1 hour anymore. So all those time frames that we had in context are not in context anymore. And that is very important. So here, if price has no reason to come back to this low, then we cover that low, right? So where does price have absolutely no reason, no business of coming back to? it's this low. And if it does come back to this low, then we know that this low is also going. So that allows us to refine the stop loss a little bit more and squeeze out a little bit more RR. That is what we're looking at right there. Which, of course, that ST on the 15-minute wouldn't necessarily be an entry pattern, but right there, that is how we can go about it. So right here, what are we looking at for that read? We have this entry right there. So that is the entry. Where do we now place our stop loss? Well, where does price have no reason to come back to? This low right there. Why not? This is the new order flow lag higher right there. All right. So it's important to understand right now that it's a checklist. It's a very simple checklist. The first question would be, where does price have no reason to come back to? That question is there, so you don't need to go over the checklist anymore. So for me, I just ask myself that question and I don't go over the checklist. Because if I constantly need to go over the checklist, etc., that's very time consuming, and checklists are great in first instance, but after a while, once you gain the experience, it's just a pain in the ass to constantly go over a checklist and see, all right, do we have this? Do we have that? It's like, I don't want to do that. I just want to ask myself a very simple question. If we are going higher, where are we going higher from? If price no reason to come back to, where are we then going higher? Where's our stop loss? If you can ask those questions, then I already know the checklist that I should be answering. That is slowly the transition that we are going to make. So first answer that question right there through the checklist. Then eventually you can remove the checklist and you can just ask yourself that question. So the question again that I'm aiming at is, where does price have no reason to come back to? All right, what is the checklist? What is the order flow lag on the entry time frame that we are looking at? So the entry time frame, the original entry time frame that we're looking at is here the 15-minute. So we're looking at the 15-minute right now. This is the order flow lag higher right there. So based on that, we know, all right, price has no reason coming back towards this low right there. But again, that is the first thing that we need to understand. The second thing is that filtering list, because now we need to see, is that truly so? How can we see if that low is truly protected and if that low should indeed not be traded back into? If from this moment where everything is in context, from this moment, the lowest point towards this low right there, if there is no 1 hour fair value gap, no 4 hour fair value gap below that order flow lag right there, then this indeed is the low right there that we can cover. Then this becomes the protected low. So let's take a quick look at the 1 hour and the 4 hour. 1 hour, no fair value gap below that low. Perfect. 4 hour, no fair value gap below that low. And below that, we have the daily fair value gap. So above that, we have the daily fair gap, which we're already coming into, which means the daily is already in context right there. All right, so we definitely have no reason to return back towards this low right there, towards the lowest low. But now we can refine that towards this low right now, because that low creates the new fair value gaps higher. So we are constantly refining that. Can you see that? Where on the daily, and this is very important because this will make it very easy to understand. Where on the daily, the recent swing low that we had no reason to return back to is this low right there. Perfect. After that, if we come into that daily fair value gap and we get the right confirmation, etc., then now it's this low. After that, if we get the right confirmation again, new order flow lags higher, then it's this low. So the checklist that we went over right there is quite simple. It's a quite simple checklist. The first question you're going to ask yourself is, where does price have no reason to return back to? Perfect. All right, that might be a bit vague in the beginning. That might trigger the wrong emotions in the beginning, where you're all of a sudden thinking of old concepts that you were using in the past, etc., that we need to unlearn. And so that might be a little bit vague. All right, let's then first incorporate the checklist. The checklist being that what is the, well, you could define a little bit more. What is the entry time frame you are looking at? So what, for your entry pattern, what is the time frame you are looking at? 15 minutes? Perfect. What is the most recent 15-minute order lag? So what lag are you about to enter on? What lag are you about to enter on? What is the lot of that order flow lag? That lot is the protected low. That is where your stop loss should be. So the order flow lag you are going to enter off of, in that lot, in that order flow lag, you have the lot, the last line of defense, which is a swing low or swing high if we're looking at bearish price action. That is where your stop loss is going to be. Unless, and this is where the last filtering process, the last check comes in to see if it's really valid right there. What is that last check? Below that lag, below that order flow lag that we are about to enter on, below that lot, is there on the time frame above it a fair value gap? A fair value gap below that lot if you look at bullish price action, and be above that lot if we're looking at bearish price action. Here the answer was no. So this right there is the perfect entry to continue higher off of. So let's say right here we were looking at the 5-minute time frame. Is that a great example? Yes, that is a perfect example. Or let's just take the 1-minute time frame right here. Now we need to take into account that we are creating a 1-hour fair value gap higher right there. So this does not become the ST plus read. This is the ST entry right here. For the ST entry, you always want to look to cover the intermediate term low or the intermediate term high. Sorry. In other words, the sharp turn. That is always what you're looking to cover for your ST entry. You're looking to cover the sharp turn low or sharp turn high, which is the intermediate term high or intermediate term low. But this can be refined. The reason being for that is the same reason that we went over on the 15-minute. Because we have this sharp turn low. And then we also have this swing low. So what do you cover? Well, I just mentioned to you that you would ideally cover this low right there. That is as a general rule of thumb. You cover that low. And that is true because usually we do not even create a new swing low. But right now we can cover this swing low. Why is that right there? That is because right there we have refined our swing low. Is there a reason for price to return below this low to then respect the sharp turn low? Is there a fair value gap there on a time frame above it on the 4-hour? No. So there's absolutely zero reason to come back towards this low and sweep this low to then not sweep this low. If that happens, again, then we need to understand that is probability. As in there's a high probability that if we sweep that higher swing low, we will also go for the sharp turn low. There is a probability right there. So it's very low probability to sweep this low and then not sweep this low. If that does happen, again, that understanding that is probabilities that we are working with. Now, we could also see it, and the reason why we are using the lot right there is because we simply want to always be a part of the move. As in, if we cover, for example, the fair value gap and we try to refine our stop loss too much, then you'll see we oftentimes get tagged out before we get the right move that we want to be a part of. So all the hard work that you have done on the higher time frame, all the hard work you have done on finding the entry pattern, all the hard work of keeping your psychology in check has now basically you are doing yourself a disservice. As in, you did not pay yourself right there. And that is very important. If you're doing that hard work, then it's better always to be a part of the move than refining your stop loss too much and then getting your stop loss hit and then seeing the move play out. Because that is, of course, doing yourself a disservice right there. So that would be for your sharp turn entry right there. Now, what I wanted to show you on the 1 minute time frame is that on the 1 minute time frame, we had a few order flow lags going higher. So if we have a few order flow lags going higher right there, then let's see at what time this 1 hour order flow lag was actually being created. The 1 hour order flow lag, let's see, was created. The 1 hour fair value gap is created at the close of this candle, which is 5 a.m. right there. 5 a.m. is that candle close. So that is where we open with that fair value gap. So at 5 a.m. right there. Right there. That is where we now have a 1 hour fair value gap. Of course, before that, we can also already take that into account, right? That we are creating a 1 hour fair value gap. So would this be an entry above there? No, likely not, because in about, what is that? In about 45 minutes, we are creating a 1 hour fair value gap below us. So we would need price to absolutely shoot higher and go to the moon in those 45 minutes if it doesn't want to trade into the 1 hour fair value gap. It's not very realistic. So right here, if we were to enter, for example, off of this 1 minute order flow lag higher, we had somewhat of an ugly ST, somewhat of an ugly RE, etc. Doesn't really matter. I'm trying to show you the premise of why we cover certain lows. Then this low right there, would that be a good stop loss placement? Well, first of all, we need to go back towards which lows were protected. The previous low that was protected was this low that we had right there. So in those lows, we need to take into account, all right, where are now the new protected lows? Let's look at the 5 minute. On the 5 minute, we had this new protected low right there. And we also had this new protected low right there. This new protected low that is sitting right there is already what? It's already invalidated. Why is that? Because if we go over the checklist, right here, if we were to enter off the 5 minutes, just as for example's sake, right there, of that fair value gap, were to cover that low, then at that moment in time, we did not create the 1 hour fair value gap just yet. But we do have a 15 minute fair value gap below it already. So right there, we need to understand, all right, we want to enter the checklist. First question, where does price have no reason to return back to? Well, that is that 5 minute low that we have right there currently. Because the checklist, if we look at the entry pattern time frame, what is the recent order flow lag on the entry pattern time frame, and what is the lot, the last line of defense in that order flow lag? That is that low sitting right there. Perfect. So we would cover that low. Now we need to go through that last filtering process. The last little check that we need to do to make sure, is that really so? Is that really true? Well, on the time frames above us, is there a fair value gap below this low towards that low, the most recent part, the lowest low that we came into the PDA, that we are confirming. So we're confirming the daily fair value gap. This is the lowest low that came into that daily fair value gap. Is there a fair value gap on the time frame above the 5 minute, below that order flow lag in this area right there? The 5 minute, again, the same time frame is not valid. As in, yes, we have a 5 minute order flow lag below it right there. That's not valid. That doesn't matter. It's not relevant. It's only on the time frame above it. That's the only relevant thing. Because otherwise then, there's always going to be a reason to not cover those lows, right? So that is not the relevant thing. It's on the time frame above it. So on the same time frame, order flow lag and fair value gaps below it, no, it's not relevant. It's on the time frames above it. So here, the 15 minutes, yes, we already have a 15 minutes fair value gap sitting right there. Right there. So that 5 minute order flow lag right there is not what you want to enter off of. Now you want to look, all right, on the 15 minute, what do we need to cover here? Well, the 15 minute where price has no reason to return back to is this low right there. All right, well, this is where right now the position, the day trade that we were about to take sort of turns into a swing trade. It's not really what we want to do. But if you were to cover this, then you, or if you were to enter this, then you would need to cover this low. Unless in this area again, right there, there is a 1 hour fair value gap. No, there's not. Is there a 4 hour one? No, there's not. All right, perfect. Everything is in context. We can cover that low right there. Absolutely perfect. So that is exactly how you would go over it. Now, that is when that 1 minute time frame right there, that is the exact same thing that you would want to do. You would want to look, do we have something on the 5 minute? All right, yes, we have that low. On the 15 minute, it becomes this low right there. On the 1 hour, it becomes this low right there. Now we have an interesting thing, because here we have the 15 minute is this protected low. On the 1 hour, it's this protected low. So which one do we now cover? The 1 hour or the 15 minute? If you're entering off the 1 hour here, then I would always advise to use 1 hour tools. Meaning, if we are entering off the 1 hour, then we are entering off a 1 hour PD rate and we are covering a 1 hour swing low or swing high. We are not refining that anymore to the lower time frame then, because that again can only confuse us, can only be detrimental eventually when refining too much. That doesn't make any sense. So here, just cover this swing low right there, not that swing low. So this is where the 1 hour right now is in context and we deliver towards the highs. That is our stop loss placement. So let's go over a few more examples as well, where again, I think you already guessed it, we have the next example as well here on Euro US dollar, where we were looking at this weekly fair value gap being traded into right there. So of course, you already guessed it, on the daily. What did we do? On the daily time frame, we created this unusual context right there. That unusual context, where right now we are disrespecting everything and we can look to deliver into the weekly fair value gap to potentially continue higher off of that. So on the 4 hour, let's see, do we have anything? No, but we can again refine that high towards that high. Then on the 1 hour, we have this right there. That fair value gap to continue lower off of that right there. So right here, we can now go into the lower time frame right there to look for our entry. On the 15 minute and on the 1 minute right there, let's take a look at this entry again and let's see where our stop loss placement would be. All right, we have our ST, like we mentioned, ST right there and our RE sitting right there. So if we were to enter off of this right there, that float, and we then cover this high, because that is, again, that is the most recent order flow lag that we had, right, on the 1 minute time frame. That's the most recent order flow lag that we had lower. There's the lot of that order flow lag low right there. So that is what we want to cover, right? Don't forget the last check. What is the last check? Is there above this high right there something on the time frame above us that could be that is a fair value gap on the time frame above us that could be hovering above that order flow lag right there? In other words, is there a higher time frame in this case, 1 minute and above, as in, is there something on the time frame above the 1 minute fair value gap that is being created right there that is hovering above that order flow lag? Let's look. On the 5 minute, do we have a fair value gap above that order flow lag? Yes, we have one right there. This already, again, that last check now invalidates that stop loss placement on the 1 minute time frame. Because right there, it is now not that crazy, right, that we are sweeping that high to then continue lower overall. So here, again, what you want to do is you want to at least cover the fair value gap, but don't suffocate it. Because if we now do trade back into that fair value gap, do you think there's a chance that we come into it perfectly right there and then continue lower? Yes, for sure, we could do that. But what are the odds right there of us doing something like this to then continue lower? All right, well, then let's just cover the bodies right there of the highs. Since it's a very long wick right there, you can allow yourself to cover the bodies. That's usually what you see me do. If there's very long wicks, we can refine instead of taking the wicks. So instead of taking the swing high right there, taking the bodies of the candles. Because at this moment in time, there's no reason for price to come back above this fair value gap alone. But we mentioned, all right, it can potentially sting above the fair value gap a little bit and then continue lower. Well, will it sting above this right here all the way above this. No, that doesn't make any sense. Because if we are continuing lower, then we are continuing lower off of that fair value gap that is sitting right there. Because that is you could argue, the first line of defense right there. So that is where we are going lower from. So that should be respected if we are continuing lower. So we are taking into account the body to take into account the rejection we might have. To take into account that we might play around a little bit above the fair value gap, might sting above it a little bit. That is those wicks that are playing right there. Those wicks that we could see happen that are stinging above it. But the body will respect the fair value gap right there. So that is what we need to take into account again for our stop loss, where we can cover the bodies, but if we were to cover the swing high all the way, the wick, then this would turn also into a swing trade, which we would not want to. So cover the bodies to refine our stop loss a little bit, to then right there continue lower. Leads me back to the same point that if we are coming above the bodies right there, then what are we doing? We're also likely coming above the high right there. So that is how I view that. And that is where the 1 minute high that we had right there, this high is not a good stop loss placement. You want to cover the 5 minute fair value gap and the bodies at least right there. That is, again, using the same checklist that we had, where this price have no reason to come back to. And the thing, if we can define where this price have no reason to come back to, again, that's done through the order flow lag. What is the lot of that order flow lag? And then the last check, all right, is there a fair value gap above that order flow lag or below that order flow lag on the time frame above it? The reason that is we are doing the exact same thing as finding our entry pattern. Because if there's no reason for price to come back to, then all fair value gaps are mitigated. They have already been traded into. If there's a fair value gap open, if there's a fair value gap left open, then we do have a reason to come back to. So here, the 5 minute right there, the 5 minute right there has a reason to come back to. But on the 1 minute, again, you would not use and you would not look at 1 minute fair value gaps above that order flow lag, only on the time frame above it. That is very important. Then once we have that 5 minute fair value gap also in context, so we trade into that to then continue lower, then everything is in context. Unless we create, again, what we're seeing here as well, we create new 5 minute fair value gaps. Then it's the same exact premise where just because we have that 5 minute fair value gap right there, yes, we need to take into account if you were to cover this or to enter that, you need to take into account these fair value gaps. But if we now create this 5 minute fair value gap right there and you were to enter off of that, then this right there would be the initial stop loss placement, that high. Just because we have 5 minute fair value gaps right there, again, same time frame is not relevant. It's not relevant for the order flow lag and what's above it. But what is relevant is the 15 minute. And the 15 minute already had a sting into that fair value gap right there. Again, the small 15 minute fair value gap, the fair value gap that we're having there, is also not relevant as long as we have that all those lags in context right there. So here, the only reason on why we would want to cover this high right now is if there is now a 1 hour fair value gap above this order flow lag higher right there. So let's see. On the 1 hour, no. Perfect. So this stop loss placement right there is perfectly fine because everything is in context. All those order flow lags are in context. All right, perfect. Which leads me to the next example again, where if we go over GU really quickly, this example should then be quite easy to understand overall. Where we had, again, of course, the monthly fair value gap. We're trying to continue lower of that, create the daily ST right there, which right now, all right, our stop loss is above that high. Perfect. Well, that is perfect, yes, but that is a little bit too far, right? It's a little bit too high. Good. So let's refine that. If we can now look for an entry pattern on the daily fair value gap, you can look to continue lower off of that. All right, we have potentially the float or we have the odd right there, whichever one you have decided for your entry type to be. Then you would cover this high right now because that is simply the sharp turn high. There's no way to refine it right here. It's just only thing I could think of is the bodies, but even the bodies right there, I would argue All right, you already have a great entry. Let's just cover the swing high. Let's not get suffocated. Let's not get traded. Let's not hit our stop loss before we hit our take profit right there. That's not what we want to do. So let's just cover the swing high right there. The RR is perfect. There's nothing wrong with it. So at this moment in time, this is a quite easy stop loss placement. Just the swing high sitting right there. Perfect. So now we can go to the next example, which was, of course, the last one is Canadian dollar CHF. We have been going lower on the weekly time frame, and what we wanted to see again was the weekly verwijking hold towards the previous week low, sitting right there. Perfect. That is our target, our context, continuing lower off of that weekly verwijking right there. So on the 1 hour time frame, what do we see? On the 1 hour time frame, we had this scenario going on where we used the replay tool to clean it up a little bit. We had this verwijking lower already. So we already had a 1 hour ST, which already indicates that this high right now should ideally be protected. Should ideally protect. Is that super high probability though? No, that's the reason why for the 1 hour right there, in combination with the weekly PD ray, we use 1 hour ST plus a re. All right, perfect. But we can, off that 1 hour ST, already look at a 1 minute ST plus re or 5 minute ST. So here, coming into that breaker right there, let's see. The covered or the protected high currently is this high. Once we come into that verwijking, create new verwijkings lower off of that, on the lower time frame, those highs should now be protected. So on the 1 minute time frame, what we can see is that we have the 1 minute ST plus the re, very, very clean price action overall. 1 minute ST plus the re, and then we create the re right there to continue lower as well. So our entry could be somewhere around there. Again, the entry type is not really relevant right now. It's whatever we talked about in the previous video. It's more so looking at the stop loss placement here. The stop loss placement, what would it be? Well, first the protected high is that high. Then the protected high becomes that high right there. The new order lag lower. Now we need to see if we enter off of something like this and we cover that high. That is again the recent order flow lag. That is a lot of the recent order flow lag that we are entering on. All right, but the only check, the last filtering process that we need to go over is there a fair value gap on a time frame above the 1 minute time frame, above that 1 minute order flow lag lower? Meaning, very simply, on the 5 minute, let's check. On the 5 minute, there is that a fair value gap? Let us check. No, it's perfectly equal. So that's not a fair value gap, which means that already there is no fair value gap above that 1 minute order flow lag. Because of course, if there's no 5 minute fair value gap on the 15 minute, there's also no fair value gap sitting right there. Perfect. So on the 1 minute time frame, everything right now is indeed in context. So we can allow ourselves to indeed cover that high that we had right there. So this high is a good stop loss placement. But we do have this 1 minute fair value gap above it. That is not relevant. The same time frame fair value gap is not relevant for what's above it. It's just looking at the time frames above it, etc. That is what we want to do. So this is the very basics of stop loss placement right here. Now, of course, our basics are already quite advanced. This even goes a little bit further, where if we truly start to look at the details, then we can go a little bit further in depth as well. That is for another video, because this is just simply the basics, what we need to understand first. If we can understand this, then we know, then we have a great idea. We are probably in the top 1% of stop loss placement. We already know a whole lot about stop loss placement. That is exactly where we want to be right now. So that is exactly what we are also looking at, right? To achieve that top 1% right there. So practice this and look at some examples, etc. Do some case studies, and then we'll move on to risk management as well. And the next things as well that we need to know is, of course, where do we actually target? What do we look to target? All things that we need to talk about. Perfect. Thank you.